Good evening. I'd like to welcome everyone here to the Hurley Investments Financial Services Commentary for Tuesday, the 18th of December, 2018. This will be my last commentary for the year. I'll have a couple weeks off, but for those that have been registered, I will send out a pre-recorded commentary on probably Wednesday the 26th in the morning, and then Wednesday, January 2nd. And I will also get those of you that are here pre-registered for my new version that I'll be running into next year. But glad to have you guys with me. Glad everyone's here. Kind of a packed house. Of course, I will send it out via email. Lance, good question, good question. And let's go ahead and get started. Well, here we are at the end of the year. Let me ask a couple quick questions. What is the historical return on the S&P 500? Or when you get quoted by someone that's a money manager like myself, what is the historical return? Mod says 8%. Historical S&P 500. And you know what? I'll go with that. In fact, there you go, Lance. It's usually between a 7.75. Come on, Hurley. A 7.75% return to an 8.125%. So give me some understanding here. When does this typically start from? When does your historical return start from? David said since the beginning of time. That is not correct. When I'm not in the market, that's a good one. Since the start of the S&P 500, well, actually, it's even before that, so to speak. When the stock market started. That's Jesse T. That is not typically correct either. In fact, most of the time when you see a historical S&P 500 return, it's dated to 1951. So if it's dated in 1951, what is that historical S&P 500 miss? If your historical S&P 500 is since 1951, what does that miss? Mod nailed it. The Great Depression, World War I, World War II for the most part, right? I may have to check some of my numbers on World War II there, but it missed some obvious gaps. So if you have a 7.75% return, my next question historically, how often does that double a portfolio? If you're getting that 7.75% return, how often does that double a portfolio? Okay, there's a couple question marks coming in. You don't know, and that's fine. Lance says every 7 years, and David says about 7.75. It's supposed to match. Okay. Rich says 9+ years. I'm going to tell you Rich is closer. Well, actually, I probably have to give it to Rich, right? I came up with about 9.5 to 9.75 years. And it's somewhat simple. Doesn't mean it's 100%, but it's somewhat simple. The easiest thing to do is to literally, and let's see if I have it. No. No. Where would I have had that at? I wrote it on a piece of paper. So one of the easiest things to do, it's the rule of 72. That is correct. Where in all honesty, your first year, right? You're supposed to come up with if you put $100 in, put $100 in, that's going to be 107.75. In year two, let's do it this way, a little bit easier. Year two, you take that 107.75 and you multiply it by 107.75 times 1.0075, excuse me. 107.75, come on, Hurley, times 1.0775. And your second year, you come up with 116.10. Should we keep going? Should I keep going for you? Why not? Let's keep going. 1.0775 is going to give you a third year of 125.09. Fourth year times 1.0775 is going to give you 134.79. Fifth year is going to give you, we're getting closer, 145.24. Think we're going to be able to do it in 10 years? Rich, while I'm typing this in, will you give us a brief overview of the rule of 72 that I can read out for our individuals? 0.49. And Lance just typed in, every 7.2 years, you're supposed to be able to double a portfolio. I thought it was pretty close to that. That would have been my expectation. But I'm going to let Rich, if he doesn't mind, type in his expectation while I keep going. I'm trying to double a portfolio here, right? Times 1.0775. Ooh, we're getting closer. After 8 years, you've almost got your portfolio doubled. 9 years, 1.0775. Sorry, I wrote all this down on a piece of paper, and it looks like Rich is going to beat me because I would have thought it was about 9.5 to 9 to, I'm not saying it right. Would have been 9.5 years to about 9 3/4 years, but we're going to be able to tell right here. We take that less multiplication. We're at 210. So we gain about $15. So in all honesty, it'd be about 9 years, 4 months. Rich, you beat me by 2 months after my expectation. So it doubles in 10 years. Let me go to my next question. Most people have how long to invest before retirement? How long do people have to invest until the retirement? And it's it's an expectation. I have 45 years. I have 38 years. Well, it's interesting, right? It depends when you get out of college. If you fast track yourself, you're probably at age 25 when maybe you start your first real job, right? Maybe you could be 23. I would figure you'd work that first year. So maybe the earliest you could start would be putting into a 401k at maybe age 26. You retire at 65. I came up with roughly 39 years where you could be in the stock market, right? Which means you might double a portfolio 4 times plus money added. Interesting statistic. When in your lifetime is the most money usually added to a trading portfolio? Mod nailed it. 50 years plus. After you're 50, because you raise kids and they cost you a darn fortune. So unfortunately, the compounding part is done in your last quarter or gap of your investing. For myself, I am 46, and I have been in the market since 2000. So it's been about 19 years. So I was there at age 27 is when I started putting money into the market and started doing my investing. 401k, trading accounts, and that's the way I am. Also made a mistake, bought a house, maybe bought a second house. Oops. So let me ask a little different question. Since 2000, what is the average rate of return for the S&P 500? These are going to be some shocking statistics for you. And Jesse, normally I'm not so simple in what I want to talk about. It's usually more market related, and I will bring it back. And actually, I think I see a Lisa. Jesse and Lisa, welcome for the first time. Maud says 5%. Any other guesses? Somewhere between 7 or 9.5%. That's somewhat optimistic. Because remember, you can go from like 97 to 2010 and have a 12.5, 13-year flat session. Pretty sure the number is 4.5681. So let me throw one other question. If you had $100 invested in 2000, did you double your money yet? I have 3 very clear and very quick no's. I'm going to go ahead and I'm going to show it to you a little bit differently. This is what that data looks like. As a registered investment advisor, when I was working for J.P. Turner, offshoot of J.P. Morgan, out of Georgia. Where was I? Atlanta, Georgia area. My quote was, hey, we've got these funds, the average rate of return, 7.75. Well, unfortunately, that average rate of return is that red line. So let me make it pretty simple to you. No, you haven't doubled your money. And average rates of returns are not your friend. Story of a dollar. If I had $1 that gained 50% and lost 50%, it's a 0% average rate of return. How much is that dollar worth? No, it is not worth $1. Thank you very much, David and Lance. Jesse, it is not worth 95 cents. Don't guess. Jesse T, do the math. Lisa, a 0% average is not $1. Your dollar goes up by 50%, it's worth $1.50. It loses 50%, it is only worth 75 cents. And Jesse, it's pulled. If it went the other way, it wouldn't have mattered. If it lost 50%, your dollar goes down from $1 to 50 cents. Back up, you only have 75 cents. You'd actually would need 100% return to get back to break even. Let's do the story with a 60% gain and a 45% loss and see what it equals out to. Dollar becomes $1.60, right? Your $1.60 takes a 45% loss. That means it's only worth 55%. So it would equal 88 cents. How often do these happen? I'm going to tell you all the time. On average, you have a market crash of 20% more, 4.45 years. But the funny thing is, if I take this data, and I should just cut it on in here for you. Copy it, throw it on in here. This is not the right one. That is not the right one. So if I throw that on in here, your $100 through 19 years is worth about less than $1.88 because now instead of the market being down 0.84, we're now down 4.77% for the year. So why am I telling you all this? Comes down to one question. Are you okay with having some stock jockey try to outguess the market and when the markets are down, you are expected to pay them to tell you just ride it out. Don't worry, it will come back. Don't worry, we will get them next year. When in all reality, unfortunately, for most money managers, the job stops when they get your funds, put it into a fund, don't look at it for a year, and get paid a management fee and a commission for the amount of money placed into funds. FYI, you get paid more to put it into a bond fund, 7 to 8.5%. Really quickly, can everyone make sure that Abraham out in Brazil, can you guys able to see the screen? Is it coming across to you? Abraham's got it. Perfect. Okay. I've got a friend from Brazil that comes into these even. So, where am I going at with all of this? Sometimes you have to think outside of the box. There are accounts that I will not beat the S&P 500 this year. Reason why? Apple, Baidu, Facebook. But for each of those, in some way, shape, or form, by using the long put as insurance, I'm nowhere close to losing 35 to 40%. And I have added shares with the profits from the long puts into their account without asking for more money to dollar cost average. Kevin, why don't more people do this? Why don't more people use that stock ownership insurance to protect themselves? In fact, I had someone just recently that sat there and said, you know, how did he say it? You know, if everyone is doing this, why aren't they doing this? And it kind of comes down to why would they? People have been so trained just to put it into funds, to pay a management fee, to pay anywhere from geez, 3.5% to 8% to be in a fund. To also have commissions. To go put it into ridiculous fees of annuities. So trained to believe an unproven story that's just a story. Why would these guys have to do anything different? They don't have to. So I'm going to go to a little different section here on the questions. And I was asked, well, what's working today? Full collar trades. Using a short call to pay for most, if not all, of the long put cost. This will make up 80 to 95% of the downward movement. So, have I been doing this all year? No, I have not. I have not added that short call, but I'm in the process tomorrow to adding a lot more short calls because of the higher volatility. What about a quicker money maker type strategy for monthly income in this volatility? And so for the last couple weeks, I went back to 2008 and what worked. And the question was asked, do strangles work now? What do you guys think? Are strangles and straddles something that's more viable? That you necessarily wouldn't want to put on first thing tomorrow, but possibly after the Fed announcement, it might be a really good opportunity. And so I've put a couple on the SPYs, as has Jeffrey. I've put a couple on the Qs, and I've come to the conclusion that most recently, and you'll see some of these that I manage accounts for you going in. Pretty simple. For a $2,300 trade, and let's see when this was put on. This was put on the 13th, so it was last Thursday at 3 o'clock towards the close. For a $2,300 investment at the close of last Thursday, I placed a Qs in the money, which means that long put that was sitting at 1650, the long call, 164.50, the long call at 164. At this point in time, the Qs was trading at probably right around 164.32. Put an order that said, hey, when I get out at 10%, go ahead and close it out for me. Want a bunch of these to come together so they'd start to work. And as we close this, the call side that makes money going up that I spent almost $1,200 for, right? is only worth $492 $2.96. But the long puts that I bought, that insurance strategy, right, that I also spent $1,119 for, is now worth, when I sold it, $1,994. Comes out to $2,489.90 after commissions. So, and this was on the 17th, which was yesterday. So I put this trade on an hour before the market closed on Thursday. I sat through it on Friday. I sat through it on Monday and Monday afternoon with my request to sell it off at $2,500. I made a $200 return, or 200 divided by, looks like 2,300, right? 200 divided by 2,300 comes to an 8.69565% return in 2 days. Well, actually 3 days, right? 3 days of being in the market. And they're real numbers. Why is this important? Well, it's important because our stock market is on pace to do worse than the all-time worst stock market of 1931. And it's funny because I could never understand, why would the historical average start or date back to 1951? Why would they start it so late? Why is it 1951? Well, it misses the 1931 December. It misses the 1937 December, the 1941 December. By going back to a historical average since 1951, it took out the most recent worst Decembers for the S&P 500. In fact, for someone like me who's only been in it since 19 years, 2000, I've only got one December to worry about. Yet it was like 2001 that was the worst year I could remember before we went to 2008. Kind of interesting. Something else to point out. You're not going to be saved by being in the Dow. Yet the Dow also has 1930, 1941 not in there. 1936, 1937. Doesn't look as good. Something else that's interesting. What can you tell me about the S&P 500, the NASDAQ, the Dow? What happens almost on a yearly basis? Trick question. What happens almost on a yearly basis on, Maud made the comment, Santa Claus rally, which is true. And Abraham, I missed it. Abraham made a comment, maybe some negative Vega trades. I don't know about negative beta, but negative delta trades would work very nice. As for time bleeding off, not necessarily. It won't overcome the drops in a day. So I wouldn't tell you a negative beta trade, but a negative delta trade would definitely. What else happens on almost yearly basis for the S&P 500? The Dow. Definitely the Russell and the NASDAQ. Abraham, I'll hit that in a quick second. If I can pick on Dave, we talked about this, David, excuse me. David, we talked about this yesterday morning, I think. If not yesterday morning, it was Friday morning. What did we talk about? Can you remember? There you go. The losers get taken out and replaced with new companies. And those new companies are usually big winners, right? Of course. Of course. I'll agree with that. So you can have for 10 months a crappy stock like AT&T, have it booted out. All of a sudden you come in with an Apple. Doesn't necessarily work in a year like this year, but a lot of the years you have lost the losers of the S&P 500 or the Dow. So if you're asking me where markets are going to end this week, expect a down week from here. Reason why? FOMC rate decision tomorrow. So really, until the last hour and 45 minutes, last 2 hours of the market, the first 5.5, I guess 4.5 don't matter. Nothing matters till the Fed announcement, and they're screwed. If they don't hike interest rates, then there's something worse off than you expect. They see something on the horizon where they're already not, all intents and purposes, they're not giving an interest rate hike, which is as if they're giving you a free interest rate discount or lowering the rate. So the information must be worse than what we see or know. If they do give an interest rate hike, President Trump kind of said it well enough. The market may be ready for it by way of GDP, which we find out on Friday, but the stock market's not ready for it. If we look at our chart, we are definitely bearish, but there is a little positive hope here. We have the opportunity to possibly bounce off of some support on the RSI. If I open this up all the way, we do have a pivot point down here at 23,352. That would coincide with a Fibonacci or an Elliott wave of roughly 8.33% just on a wave one pullback. You also have that on a wave two retracement expectation. That's 16.88. But the other side of things, big money. Woolens percent R, your medium, stochastic, the big money investments. Oversold, big money's not moving into the market right now. With that said, as you take a look at an S&P 500 chart, pretty simple. It obviously is also going to be bearish, and it mirrors the Dow, except it already passed below today. We already passed below that retracement, which tells me there's an opportunity for this not just to be a 16.66% high from the highs. We could be looking at that 35% drop that Rand Paul has been harping about for years, right? Don't want to give him too much credit. If you're always calling for the earth to come to an end, someday you will be right, Rand Paul. And obviously for the NASDAQ, it is exactly the same. It is also bearish, but we're not down nearly as far from the highs or for that monthly pivot point at, what is that, 6502.57. So the NASDAQ looks to be holding up a little bit better, even though 83% of the NASDAQ gains came from the FANG stocks, those 7 FANG stocks. All right, where will we end December on the S&P? I've consistently gone lower. Right now, yes, we are down more than that. Where is that one? There we go. 7.8%. I'm only saying 4%, but chances are tomorrow will be the knife in the heart. Chances are tomorrow, if our market reacts negatively, we'll see the last big money in selling out most likely on Thursday, and you're going to run the next 2 weeks on really low volume, really wide spreads. I would tell you don't worry about it with next Monday, the market closing at 1 o'clock Eastern, and it's closed on Tuesday. We have 2 days where the market's closed next week. And then the following week, the market is only closed on New Year's Day, Tuesday, January 1st. You do a full day on New Year's Eve and a full day on Wednesday, January 2nd. Big money will not come back into the market till January 2nd, which means wider spreads, more volatility. Money makers should easily be able to keep up with the buying and selling, but it will be on low volume, so the spreads will be outrageous. Basically, the money makers will know individual money, retail money for the most part is in, so they will try to take advantage, and you'll see really spreads blown out to a ridiculous amount. Earnings, Darden Restaurant, Micron today. Micron missed. It's already down 7.68%. And I guess actually Micron beat on the top and bottom line, but the guidance, they're starting to bring in guidance like FedEx. There's worry into next year. I could go through, but I'm going to kind of save it for next week. There should not be any recessionary fears. We are not looking at too negative quarter over quarter GDP ratings. It's not there. There's no recession into next year. The fear of a recession is giving a significant buying opportunity right now. I am not telling you go and purchase a bunch of stocks. We have not found a bottom. We are not bottoming. In fact, there's more risk to the downside with consumer confidence numbers and CEO confidence numbers and revisions of yearly guidance going into next year. The risk is to the downside. The risk is not missing an upside run right now. GIS. What the heck? Why am I not remembering GIS? General Mills. Pier 1 Imports. Rite Aid. Paychex. WBA is Walgreens Boot Alliance. CTAS and Nike on Thursday. CarMax on Friday. really, FOMC rate decision runs our market. A worse than expected GDP number or a higher than expected GDP number will juice the markets one way or another because it will be such low volume. No one's really going to be in on Friday. So you can see big movements on Friday through retail investors in the market. Internationally, I didn't even bother to look. There's nothing internationally that this week will take precedence over the FOMC rate decision meeting. That goes for Brexit. That goes for Brexit. It'll go for crying out loud. I can't remember. The rollover of the bonds, all those bonds in the European Union. There's a huge rollover. $1.1 trillion, where all they're doing is issuing call options. For those of you not familiar with bonds, most bonds like U.S. Treasuries have a call option. If they feel they can get lower interest rates going forward, they call in the bonds. You can either roll them into the new bonds that have a lower interest rate. You can cash them out and get your coupon of $1,000 per note, or you can just say no and they go worthless and you lose everything. It's all up to you. How am I looking to trade? I already showed you with the questions what's working, but definitely I'm rolling protection up or moving in the money prices. It was pretty interesting. An individual over the weekend brought to me a bear put idea with a $5 spread, maybe a $6 spread. I can't remember. $4 spread. Maybe not. What was it? It was a calendar. I'm sorry. It was a calendar. And kind of glad we didn't put the trade on because we would have lost on that short put or lost our first day. But definitely bearish strategies. I would not suggest you cap yourself to the downside at this time. Put some long puts on, have them act as insurance, maybe even do some as a whole against the whole market on the S&P. I chose to do some individual stocks. Remember, you will not beat the market with an individual stock. The individual stock cannot and will not be able to beat the market. The little saying, all tides raise or lower ships, 100% true. Low tides will lower all ships. Let's see here. Stock market's on pace for its worst December since the Great Depression. I've already shown you that. Interesting read. Ron Paul, a 50-cent correction will spark depression-like conditions that may be worse than 1929. Take this with a grain of salt. Ron Paul is always complaining about something. It's more realistic to have a continued this year and into next year 35-ish% pullback. But a lot of the comments are not correct. Yes, we're in a China trade war. I am thinking that will be resolved first quarter next year. I am thinking GDP numbers are still in place. We are not in a recessionary environment. He makes the comment in here that, what did he call it? The biggest bubble in the history of mankind. The Federal Reserve's quantitative easing has caused the biggest bubble in the history of mankind. Yes, there is a bubble there, but for all intents and purposes, that money has run through. We've already had the expectations. I don't see the bubble. I don't see how that money has done anything but, all honesty, hurt automotives and propped up pensions. I think because so many pensions have been at risk because of past losses, that they are insolvent for all intents and purposes, you will see more quantitative easing into the future. It's worked for Japan for 30 years. Zero GDP, zero economic growth. Quantitative easing has helped Japan at least stay afloat for over 30 years. What else do I have in here? Investment insights, managing risk in an aging market. It's pretty simple. Basically, it's still telling you your 40-60 and or your 80-20 is at big risk. Don't afraid to hold some cash or come away with an idea of a way to protect to the downside. Obviously, we have an aging bull market and we have an aging bond market. Kind of funny. He calls Jeff Gundlach has called the raising of the interest rates a suicide mission. It really comes down to nothing more than understanding, even if we could cut rates 8 or 10 or 12 times, when you go through a global slowdown, it will not fix, help, or save a U.S. market. We are becoming more of a global market, so we're in trouble. I mean, the short answer is we're in trouble. The whole rest of the world has been on fire. There's nothing that the Fed will be able to do by way of rates that will save us. It really will come down to more quantitative easing is what it's going to have to be. With that said, what questions do you guys have? What questions can I answer for you that may be helpful, something that you're in trade-wise that I could answer for you, or something other than that I can try to be of help? Come on. Hold on. Whoever just typed that question, I'm trying to get to it. Maud, have a good evening. Thank you very much. James, I think I said it already. James' question is, you want to put new money to work. James, let me go ahead and play it plain and simple. And Lance, David, we talked about this on Monday as well. Right now is not a time to put money to work. James T., if you have some money on the sidelines, keep it there. That does not mean that we might not get some weird bounce on Wednesday and you look at me and you'll go, Kevin, I told you so. But the direction of the market, it's down. We don't have any type of base in place at all. We're not bottoming. We just blew through our somewhat support level that had been hit 3 times. If I was to draw some type of charts, man, I'm down here at 2,000. And not only that, but it's not a pennant. It's a widening downturn. It's not a channel that's going to give you that type of downturn. It's up here. We kind of hit highs. You got to go from point to point. It's a widening tunnel. It's not a pennant. It's widening. Lower lows, lower highs, not a position to be putting your money to work. So James T., save it. David, save it. Interesting conversation with Dave on Monday. As he called me. And I'm sorry, David likes to go by David, not Dave. I've got a friend, Dave Westlake, that I always call Dave, so I do apologize. But same conversation with David. Don't look for bottoms now. There's nothing you can justify that tells me we're at a bottom. Nothing that would give me a run for more than 30 days that you wouldn't create some type of short earned income opportunity. Go at strangles and straddles. Give yourself the ability to say you don't know it all. Go ahead and cheer for stocks to go down really another 22% from here. If they go down 22%, you make up 20 or 18% of it. That's 18 to 22% more shares of stock that you'll get to add on the bottom. Guess what? You won't get the bottom exactly. Don't try to pick the bottoms. But if you could add 15% more shares of stock, that's more shares of stock with less of a run back up that you'll have to worry about making up this correction in our market. And really, it's only a correction. We're not into bear market territory. There are a lot of stocks that we were trading, Apple, Facebook, Baidu, that are in bear market territory, but you're going to be okay. Keep making up something to the downside. You're going to be in great shape. Any other questions you guys have? We are approaching the hour mark, but what do you expect to trigger? What do you expect to trigger you to go into the market with more force? In all honesty, I would like to see us hit that bear market territory, so I might look to be dipping new investments in at a 20% down market. I might also be looking for some possible news on a China-U.S. Trade agreement. I think that could really juice our markets because we've been down so long. But I would only enter with long put protection at the money 6 to 8 weeks out. Really, I think earnings with guidance will really be pretty awful coming into the first quarter. So, with all that said, I don't know if I don't have an expectation to trigger going into the market more right now. Abraham, that's a really good question, and I don't have that answer for you yet. I made a couple comments there, but they're not to the point where they're 100% sure and that you'd hold me to it, if that makes sense. Kevin, what are some of your favorite stocks? Well, I've got a ton. Maybe I will work that into next week as well. But really, favorite stocks or opportunities, if I was to call them opportunities, are pretty simple. Apple, best company in the world, massive hit down. Baidu, best company in China, massive run down. Facebook still has their earnings coming up. Ford can still go significantly higher. Disney has a serious run of movies that people will still watch next year into a recession. Visa, go back to, I think it was the 13th. My Hurley Investments on the 13th. And the research done that I pulled off of, who did I pull it off of? Pulled off of, oh, for crying out loud, I can't remember, but pretty sure I have that in there for you guys to look at. Nothing's really changed. The ones that I'm in, Bank of America, I'm still in because the fundamentals haven't changed. I would also tell you Goldman Sachs is a good one right now. Cardinal Healthcare, United Healthcare could be ones. Boy, you know what? I still like Chevron down at these levels, although oil's not going anywhere soon. So that would be a dividend play. It's UNH, correct. It's United Healthcare. Thank you. Thank you, Abraham. I still think there's an opportunity on American Outdoor Brands Corp. I still like Under Armour. I would not necessarily be going into Nike right now. You know, it's kind of off the wall, but Google L would be an interesting one that I think you could also make some money on. People will still be going, especially beginning of the year. More clicks, more advertising, more clicks per ad. So I think you'll see better in Google. BRK and B, let me take. The Berkshire Hathaway, I would not. I would not, as I look at Berkshire Hathaway Bs, right? Is that the one you're talking about? I would not. I would not because the way he has investments around, he's able to wait out the downturns longer than we are. And I think it'll be an interesting question. A couple of what they've been in are down in that 30% range. So if they're down that 30% range, like an Apple, all four of their banks, Wells Fargo, Goldman Sachs, First Horizon National, and Bank of America, they should not come across very well. Possibly their transportations will do better with the lower gas, but it's my opinion. I do think Warren Buffett is the best of the best, but the Berkshire B is more financially weighted, and I think finances are still in trouble, even though they shouldn't be. It's a complete sentiment play there, and it's not fair, but yeah, I mean, it just doesn't look good. You're not going to beat that sentiment. And there's obviously more downside pain to come. Any other questions you guys have? If not, I want to thank you for being here. Lisa, you're here for the first time. Welcome. And Jane B, I think, was here for the first time. Welcome, welcome, welcome. I don't know if you were able to type questions in, although you did. Yep, you said my sound. Okay. You're always welcome to 2 cents here to help you. They're here to hopefully give you some education. Thank you, Abraham. I appreciate it. Thank you, David Lance. Appreciate it. Mary, you're all my favorite. She said I was her favorite, so she's got to be my favorite as well. All right, guys. Hey, enjoy your holiday seasons. For this group, I will have some emails out that'll be just a pre-recorded commentary for the next couple of weeks. I'll start up live, so I'll re-register you for the first quarter of next year. And everyone, have a happy holidays. Enjoy your Christmas. Go ahead and put your worries away for the market. Anything that happens in this next 2 weeks will be corrected on January 3rd when big money comes back. If we're up big or down big, but the market still thinks we should be the opposite direction, it'll get corrected overnight on January 3rd. Take care. Have a great evening. Appreciate your comments, and I'll talk to you again in a couple of weeks. Bye-bye.